So we have UK gross domestic product, or GDP, coming out for the first quarter of 2007. It's a quarterly indicator, and countries such as New Zealand or Australia release their GDP 4 times a year. However, countries such as United States and United Kingdom release the report every single month. Now you may ask, well, it's a quarterly report, how can you release it every month? Well, the way they do it is, in April, for example, last month, we saw the first advanced GDP reading for the first quarter of 2007 from the UK. That was done with about 60% of the data gathered. Then as time progresses, more data is being gathered, and the following months, which is today, we have first preliminary revision of the initial advanced GDP reading. Then as more data is being gathered, next month we will have the final revision. Now, GDP is a very complicated and a very broad indicator. It basically measures total output in the country. So in this case, it measures total output in the United Kingdom for the first quarter of 2007. Of course, as the economy grows, gross domestic product grows, output grows, and it's ideal when gross domestic product can grow above inflation. But unfortunately, a lot of times that's not the case. As you can see here, the GDP in the UK is about 0.7% quarterly, which on average is about 2.8% annually. And as you already know, inflation in the UK last time read above 3%. It read at 3.1%, a few months ago. So, but still, 0.7% quarterly is a relatively healthy reading, and it's a reading for the UK. Basically, it's historically in the last few quarters, the GDP has come out. UK has a very, very steady GDP. Like United States is a lot more volatile and it has a lot of surprises. But in the UK, in the last 3 quarters, in the third and fourth quarter of 2006, we had 0.7%. Then in the first quarter, we had 0.7%. Now it's a revision of the first quarter of 2007. Before that, for the first 2 quarters of 2006, we had 0.8%. Before that, in 2005, for the last quarter, we had 0.6%. So as you can see here, it's a very, very, very stable indicator, and usually it doesn't deviate much either direction. Now, of course, the biggest move and the most lucrative trade out of GDP is on the advanced reading. It's the most anticipated report. There's the biggest chances of deviations from expectations, and that's just the best time to trade GDP. The second revision and the final revision usually are not so good to trade. Because simply the possibilities of deviations are very small. They already released the initial number. Now there's a little bit more data is gathered, but even if it's worse or better data, it takes a lot to really move this report either direction. Now I really like where the pound is right now. If it stays here before the release, I have a feeling that even if the release comes out as expected at 0.7%, we may see GBP USD go up by 20-25 pips, and it may happen relatively slowly. So I may look for after spike trades in case of the as expected reading, possibly. Now we have quite a few other numbers coming out, some other private consumption, some other government numbers. I don't know the scope of them too well, but they're not that important, I know that. And we'll just see if there's any shocks to those numbers. And if there's no shocks, if everything is kind of close to expectations, if the GDP comes out as expected, I do have a feeling that we may see bullishness in the pound. If the GDP comes out better by 0.1 point, so if it comes out at 0.8%, I have a feeling we're going to test 9900s on the GBP USD. If it comes out upsetting, if it comes out at 0.6% or something, I think it's very possible that we will see basically the pound maybe dropping by about 20-30 pips. Probably we'll see a much bigger move with a deviation of plus 0.1 rather than minus 0.1. But as you can see on my trade plan, I set the triggers, the regular triggers, 10 pips limit triggers. If plus 0.1 or more possible buy on GBP USD, minus 0.1 or more possible sell on GBP USD. And I am using 5 pip bounds on Oanda for those who are interested. And for the regular 20 pips limit triggers, if the deviation is for some reason as huge as 0.3, and that would be a huge shock if that was to happen. I mean, we'd see the pound go nuts if that was to happen, in my opinion. So if the regular 20 pips limit triggers are hit, I'm actually going to just go long or short on Oanda with regular market orders, no bounds, because I want to get filled no matter where they fill me, basically, because I think it's going to cause a sustained move. I mean, 0.3 would be holy shit triggers, and it's possible on advanced readings. On revisions, it's highly unlikely. Highly unlikely to have such situation. Even 0.2 would be big. So, and as you can see, the conservative triggers, 20 pips limit triggers, would be I would be using 20 pips limits on MB trading. If you're new, I suggest you watch the videos in the Forex Diamonds area, especially if whatever I'm telling you doesn't make any sense. Now the situation with the UK is still bullish. They are expecting at least 2 more hikes by the end of the year, considering the situation. What we had yesterday, and let me actually look at a calendar. I think yesterday we had some very crazy number come out of UK that confirmed very positive manufacturing activity. Let me see something. Yeah, we had the CBI industrial trends orders come out at 5 versus 3 expectation and versus 2 previous number. That was pretty bullish. Let me actually go and look back and see if we saw a big move on that. That'll be very interesting. That was about 6 a.m. Yeah, I mean, I think that report actually, with such big deviation, the CBI industrial trends caused about a 20 pip move on the pound yesterday, which confirmed that the industrial activity in the UK is doing relatively well, and it has reconfirmed